Hey traders, quick lesson on the difference between the SPX and the SPY. Really, the conversation is the difference between a cash settled ticker in the options world versus not. So the SPY is the ETF that tracks the index. The index is the SPX, cash index. So whenever I trade options in the SPX, it's called cash settled, because they can't, which means they cannot act early on me. So I won't wake up, if I sold a put spread, I won't wake up being assigned a position. What happens is they draw the line whenever it expires. I'll use specific examples. So let's go to Friday. Actually, let's go to Wednesday. Today, this one has 1 day on the clock. This is the SPY, the ETF. So if I have a position here, I have to worry about tomorrow overnight them acting on me. 1 day left, close to current price. If I'm short a call here, I may wake up being assigned this or that. I don't want this mess. Also on this side as well, they could, if I'm short this put, maybe they'll assign me. Definitely tomorrow night I would get assigned for sure if it stays there, because they can do that. So one way to avoid it is to use the SPX. The options there are cash settled. So at the end of the day tomorrow, they draw the line. Let's say the SPX closes at 42.40, right? So if I sold a 42.40 put spread, 42.40, 42.35, then I don't even have to close it because they draw the line to say it closed at 42.40, your risk was at 42.40, you owe us nothing. Or if it closed at 42.39 and I don't close it, no big deal, because what happens is after they draw the line at 42.40, they'll do the math between 42.40 and my risk and where it closed, 42.39, so I lost $1 per contract. But if I collected the dollar to open the trade, then I didn't lose anything. But there's no assignment. It's nice and clean, cash settled. They draw the line wherever it ends up. They'll do the math between that and the leg sold in the credit spread example, and then you win, for example, or you lose. So let's say it closes at 42.40 and I sold the 42.30, 42.25 credit put spread. Then I clearly won. I don't even need to do math. That's it. It dies. Same thing on here. If it closes wherever it closes, and they'll do the math between where it closes, 42.40, we're assuming as an example, and where I sold the call spread. So if I sold the 42.45 call spread, then I'm set. If I sold the 42.40, I broke even. Actually, I won whatever I collected because it's zero. But if it closed at 42.41 or 42, then I may have lost $1 or $2 out of what I collected. So if I collected $1, then I broke even. If I collected $2 and I made $1, if I collected 50 cents, I lost 50 cents. You follow this? It's cash settled. There's no actions. When the option expires, then they'll draw the line at the settlement price. Now, I say that because every 3 weeks, there's a hitch in the giddy up here. So let me take this out. The monthly contracts, see how they're all purple? Except these are white. We just passed a white one, which was June 18th. These are monthly. They call them monthlies. That's what we had. That's the only thing we had before when they first started. We had one and then one. We had no weeklies, nothing. Now we have 3 a week, maybe 4 a week. So July, I'm going to say 16th, we have 2 contracts. One says AM and one doesn't. They both expire on Friday. One, they draw the line in the morning, 24 days. In the morning, when we open, they'll say, okay, the final score is 42.40 or whatever it is in the morning. And that's it. The whole day can trade. It can go to zero, it can go to billion. They drew the line. They'll do the math for those who use that contract in the morning. Versus those who choose that contract, 24 days, exactly the same expiration date. The only difference that this one settles at night. Where does it close? So it could open here, it could collapse, and then that's where it is at the end of the day. Or it can run, and that's what it is at the end of the day. So that is a nuance. Cash settled The settlement part varies. Usually it's in the evenings. All of them are in the evening except this guy in the morning and this guy in the morning. Every month we have one guy in the morning. So you have to pay attention to that. And that's only on the SPX because the SPY is not like this. The SPY has one on July 16th. Doesn't have AM, PM. It trades like a stock, so only one. Expires at the end of the day. It settles at the end of the day, so whatever the score is at the end of the day, that's our score. So hopefully this demystifies this. What is cash settled again? It's easy. The SPX is a cash settled transaction. The RUT, it's the index for the small caps. The NDX, they're cash settled. There are a few other ones that are cash settled as well. It's important to know the difference, because then if something goes in the money, I'm not sweating. Oh my gosh, I'm going to wake up owning share. No, they're cash settled. They don't do any of that stuff. Nice clean cut when they draw the line. That's the finish line. In the SPX, always in the evening, except for the SPX and the RUT. Sometimes it's in the morning. So you have to pay attention to that. It would say AM. Let me show you the RUT version of these monthly things. So purple, boom, July 16th, AM. It does not have a PM. August, that's 20th, I think, the monthly contract in August, AM. September, AM. December, AM. They don't have a November contract yet. They do have a November 30th, but not a November monthly. So you see that? I have not traded the NDX in a long time, so I couldn't tell you. AM, the monthlies. Okay, so avoid that guy, in my opinion. Now, my biggest losses were in that guy and through no fault of my own. So anyway, so SPX, better than the SPY for me. Tax, there are tax implications. I'm not addressing that. You talk to CPA. I'm not one. I'm not qualified. From a trading perspective, it is, for me, the easier trade. Nice cleaner cut. I don't have to worry about actions. And the SPY pays a dividend. So that puts a new twist. Boy, Nick, what are you doing now talking about dividends? So it pays quarterly dividend. I'm pretty sure of it. So go double check. Which means if I have a debit call spread or a credit call spread that's at or currently in the money or just above the money around X dividend day, I need to worry, because there's a trick they do. I forgot what they call it. They stick you short the stock if you have a call that's short in the money or close to the money. Then the next day you owe dividend to somebody. What? Yep. It's happened to me, not from the SPY. I forgot, OEX maybe, some other index. I didn't know it could happen. Years and years and years ago, I woke up owing like $800 on a winning trade nonetheless. So anyway, cleaner cut SPX. SPY, easier risk. It's smaller. You can maneuver it a little bit more. To me, it's a cleaner cut. The cash settled indices versus the regular trading like a regular stock. Hopefully this demystifies it a little bit. There's a lot of jargon out there about that. Cash settled means there's no assignment. They draw the line, they do the math, and they settle it in cash after hours. You may also hear them refer to European style versus American style. So that's the difference between the two. You can read up on it, but all I need to know is that cash settled mean it's a matter of math, no actions, versus the other ones that are just like a stock.